Welcome back to Talk Tickers. It is Tuesday, January 20th, 2026. The closing bell rang a few hours ago, the screens are still flickering, and we are diving straight into a fascinating one tonight.
We really are. We're talking about the plumbing of the global market, Interactive Brokers, ticker IBKR.
And it is the classic earnings season paradox, isn't it?
It really is.
I mean, you've got a company, Interactive Brokers, that just printed what I can only describe as a monster quarter. We're talking record revenues, margins that are just, frankly, absurd.
Completely absurd, and growth that shouldn't be possible at this scale.
And yet, I'm looking at the after-hours tape right now, and the stock is red.
It is. We closed the regular session at $71.51, and right now it's slipped to about $70.34.
So that's what, a drop of about 1.6%?
Roughly, yeah. So a beat on the top line, a beat on the bottom line, and the market hits the sell button.
Why? What's the story here?
It's the classic sell the news dynamic. You have to remember, this stock is up nearly 50% over the last 12 months.
Right, so it's been on a tear.
Exactly. When a stock runs that hot, it is priced for absolute perfection. And I think tonight, excellence just wasn't quite enough to keep the momentum going.
Okay, let's unpack this machine. Because even if the stock is taking a breather, the numbers under the hood tell a huge story. Let's hit the headlines. What do they actually report?
All right, let's strip it down. Adjusted earnings per share EPS came in at 65 cents.
And the street was looking for what, 59?
It's 59 cents, so that's a solid 10% beat. You just don't see that from a mature financial very often.
Okay, and the top line, revenue.
Adjusted net revenue, $1.67 billion. The expectation was around $1.639, so we beat there too. But the number that really, the one that makes you just step back is the margin.
I saw that number and I assumed it was a typo.
It wasn't. Pre-tax margins holding steady at 79%.
Hold on, let's just pause there. 79%. For you listening, a really well-run software company, a SaaS business, might target 30% margins. A bank, forget about it.
It's operational efficiency on steroids. It's the result of decades of automation. Management called it a record run for the 5th consecutive quarter.
So the profit engine is humming, but profits follow growth. Are they still adding new users?
Aggressively.
Yeah.
Customer accounts just hit 4.4 million.
And that's up, what, year over year?
32%.
32% on a base of millions. That's incredible scale.
It really is. And it's not just empty accounts. Total client equity, that's the cash and assets they hold, is up 37% to $780 billion.
Nudging up against $1 trillion.
Getting very close. And commission revenue is up 22%. So the story is simple. More people bringing more money and trading more often.
So if the machine is scaling perfectly, why the red ink tonight? Is there a macro story here?
I think so. There was chatter on the call about tariff uncertainty, political headwinds. When you have a stock that's run this hard, any risk-off sentiment in the broad market is an excuse to take profits.
Right. Good news is bad news when you're already priced for the moon. But I want to get into the mechanics of this because it's not just that people are trading, it's what they're trading.
It really is. And it tells us the retail investor of 2026 is fundamentally different from, say, the one in 2021.
How so? Are we done with meme stocks?
It seems that way. So look at the volume mix. Stock trading volume up 16%. That's healthy.
Okay.
But the real juice is in derivatives.
No.
Options volume was up 27%. Futures up 22%.
So people aren't just buying and holding anymore. They're getting more sophisticated.
Exactly. Management explicitly noted a move away from the pink sheet penny stocks toward high-quality names. They mentioned fractional shares of the Magnificent Seven are huge.
That makes sense. You can't afford a full share, you buy a slice, and then you use options to get leverage.
Precisely.
Yeah.
And here's where it gets really interesting. The overnight phenomenon.
The 24/7 trading cycle.
Well, get this. Overnight trading volume on IBKR is up 76% from last quarter.
76%.
In one quarter.
It is massive. It shows they're capturing that global flow. News breaks in Tokyo. Traders are using IBKR to react to U.S. stocks instantly. They're not waiting for the opening bell.
That is a massive moat. If you are the venue with liquidity at 3 a.m., you win. But this brings us to the big question everyone had. Interest rates.
Ah, yes. The rate cut paradox.
Let's break this down for you, because on the surface, this doesn't make any sense. The Fed cut rates in 2025. Conventional wisdom says a broker like IBKR, their net interest income, or NII, should crash.
Logic would dictate that, yes. The yield you earn on customer cash goes down, so your income should go down.
But it didn't crash, it went up.
It rose 20% to $966 million.
Okay, make it make sense. How does that happen?
It's the oldest trick in the book. You make it up on volume.
What kind of volume? Margin loans. While the yield on cash dipped, the appetite for leverage exploded. Margin loans are up 40% year over year to $90.2 billion.
$90 billion in margin loans. So clients are just borrowing money hand over fist to buy more stock.
It's incredibly bullish behavior. Animal spirits are back. So even if IBKR charges a slightly lower rate on that loan, the sheer 40% jump in borrowing just wipes out that headwind.
So the volume lever is pulling harder than the rate lever.
Correct. And there's a secondary engine here that's also firing, securities lending.
The dark art of lending out shares.
Exactly. When a hedge fund wants to short a stock, they have to borrow the shares. IBKR lends out their customer shares, collects a fee, and splits it with the customer.
Which is unique. Most brokers just keep it all.
And this business is generating about $290 million for them. It's huge. And it's driven by the IPO and M&A market waking up.
So it's a beautifully hedged model. Market goes up, margin loans go up, market gets volatile, trading volume goes up.
They've really covered their bases. And speaking of which, we have to talk about the man at the top, Thomas Peterfee.
The founder.
Yeah.
He's never short on confidence.
And there was a moment on the call, or a callback to a comment he made, that just perfectly sums it up.
You mean the growth question?
Yes. Someone asked about sustaining this 30% growth rate, and his answer was basically, as long as I live.
As long as I live. You have to love the conviction. But is it just bluster? I mean, how do you actually do that?
Well, he's backing it up with strategy. First is geographic expansion. Brazil, Taiwan, the UAE, they are planting flags everywhere.
Chasing global money?
Exactly. But the fascinating part is the plumbing, specifically crypto.
I saw this, but it's not what you think, right? They're not becoming a crypto exchange.
No, this is crucial. They aren't trying to sell you Dogecoin. They're using crypto as plumbing. You can now fund your account with USDC, the stablecoin.
And why does that matter?
It's about friction. If you're a client in Brazil, moving dollars via the old Swift banking system can take 3 days and costs a fortune.
It's a nightmare. Wires get stuck, banks take a cut.
With USDC, it's near instant. 24/7, it solves a massive cross-border headache.
That is smart. And speaking of banking, they filed for a national trust bank charter. Why do they need to be a bank?
It's a regulatory workaround. Right now, they can't custody mutual funds and ETFs in a way that really serves big financial advisors.
So this is a play for the RIA business, the Registered Investment Advisors.
Precisely. They want to be the place where your financial advisor parks your entire life savings. They expect it to be operational by the end of 2025.
Okay, we have to pivot to the shiny new object. The thing that's still small, but everyone is whispering about it. ForecastX.
The prediction market. And this is where we see Peterfee FI being very, very calculated.
How so? Is he trying to compete with the election and sports betting sites?
No, the opposite. He was explicit. They are avoiding sports betting. They cited a recent ruling in Massachusetts against a competitor. They don't want that regulatory heat.
So what are they trading, if not sports?
Temperature contracts.
Temperature contracts. Yeah. So betting on the weather.
It sounds like that, but think about the real use case. Utilities. Insurance companies. A utility in Texas needs to hedge against a massive heat wave driving up electricity costs.
So it's not a gambling parlor. It's an institutional hedging tool.
Yeah.
For climate risk.
Exactly. And it's scaling. They traded 286 million pairs in the quarter. It's early, but if they become the de facto exchange for corporate climate hedging, that's a massive market.
So let's bring it back to the investor. The stock is down 1.6%. Great quarter, great strategy, dipping stock. Let's frame the debate. Bull case versus bear case.
The bull case is the operating leverage. It's undeniable. Headcount grew 6%, but accounts grew 30%. That gap is pure profit. The machine is printing money.
Okay, and the bear case. What breaks this thing?
Rate sensitivity is still the big one. Yes, margin loans offset it this quarter, but what if the market turns? Stocks drop, margin balances shrink, and rates are lower. That's the double whammy that could finally make that NII engine sputter.
And regulatory risk is always a factor with these new products.
Always a watch item.
All right. We've stripped the earnings, we've looked at the strategy. Now it's time for the segment where we throw caution to the wind.
The lawyers are sweating.
They always are. This is not financial advice segment. We are just voices in your headphones. Please do your own diligence. But Based on what we heard today, you got a trade idea. One that's outrageous, but plausible.
I do, and it riffs right off that temperature contract idea. I call this trade the global weather hedge pair.
I like it already. Walk me through the setup.
Okay, the thesis is that Thomas Peterfee is right. Climate volatility is an economic risk that needs its own exchange.
So the long leg of the trade is obvious. Long IBKR.
Correct. But you're not buying it as a broker, you're buying it as a call option on the future of climate risk trading. As weather gets crazier, volume on ForecastX goes parabolic. Every time a utility hedges a heat wave, IBKR clips a ticket.
I like it. So IBKR is the venue. What's the short?
You short the traditional insurance pure plays?
Oh, that's devious.
Think about the asymmetry. When a hurricane hits, the insurers take the capital loss. Their stock goes down. But IBKR, they make money on the volume of panic and hedging before the storm. They win on volatility.
So you are long the volume of fear and short the actual damage.
Exactly. And if you want to add a kicker, you add a small short on the sports betting apps.
Ah, as a regulatory hedge. Aligning with Peterfee's view that they're the ones who are going to get hammered by regulators.
Precisely. If he's right, those stocks tank, while IBKR is sitting pretty with its institutional temperature contracts.
That is wild, plausible, and exactly the kind of asymmetric thinking we love here. But again, please do not bet your house on our weather predictions.
Definitely not.
So to wrap this up, Interactive Brokers, Q4 2025.
A high-quality beat. Unmatched margins, record accounts, a clear strategy.
And the market sold the news today, possibly giving long-term believers an entry point.
It looks that way. The machine is working. The only question is the macro environment. But betting against Thomas Peterfee has historically been a very expensive hobby.
As long as I live. That's the quote of the quarter.
Thanks for listening to Talk Tickers. We'll see you on the next print.
Good night, everyone.